Certain segments of the markets were, of course, a little, so as to say, unhappy about the 10-year, which had gone up to 4.75 to 4.8%, is already south of 4.5%. That volatility will continue. To some extent, it will also impact emerging markets. RBI will not go ahead and streamline the day-to-day movement of INR as much. Most of the negatives have largely been priced in. And as India moves towards a rate easing cycle, we expect the rates in India to...
A 25 basis points rate cut and, of course, a path of fiscal prudence that the finance minister has set the Indian economy on. That's the setup like. What's in store for India's debt markets? I have with me Tanveer Sethi, Investment Manager for Fixed Income Strategies with Kotak Mahindra Assest Management Singapore Private Limited. Hi Tanveer, and must start off with the recent announcement from India's central bank, and that's a 25 basis points rate cut. A very big announcement indeed. Let's kickstart first with your reaction on what this means for the economy, for yields as well.
So yes, the MPC has delivered a 25 basis point rate cut, which was unanimous. And this is pretty much on expected lines. This was our base case as well. This backdrop had been created by the liquidity measures that RBI had announced at the end of last month. And the CPI inflation has been coming off. The GDP has been slightly weaker than what one would want it to be. So clearly, at this stage, RBI had the room to provide some bit of a relief in rates to boost the economy. Certain segments of the markets were, of course, a little, so as to say, unhappy about the lack of additional liquidity measures. There was nothing on CRR. They did not change the stance to accommodative as many had anticipated it to be. But here, our view was that we would not see, and we did not see any action by RBI on liquidity during the MPC. All tools cannot be used at once. They already announced liquidity measures last month. Some bit of it are yet to be taken care of. Some OMO purchases are yet to go through. And there's also an external sector risk, the geopolitics, the tariffs war that is ongoing. So obviously, RBI wouldn't want to act too fast on all counts. And they have delivered a 25 basis point rate cut. They have left their stance unchanged to neutral, and they've come back and said that they can infuse liquidity as and when required going forward. So I think it was pretty much a good policy, largely as anticipated, and should give room for the RBI to act in future as would warrant.
I want to also get in your reaction to India's budget. There was, of course, that continued fiscal consolidation with a target of 4.4% for the next financial year. What's your view?
So the budget, again, was largely on expected lines. The government has been reining in fiscal deficit and has shown commitments towards it. Our base case, again, was around 4.4 to 4.5% kind of fiscal deficit would have been budgeted. That is what they came up with. We've always maintained that though the run rate of the previous year was going towards at 4.5 to 4.6, but the government might step up towards 4.7 to 4.8% deficit. It is what they revised it to at 4.8%. So pretty much as per our expectations, most of the assumptions are quite rational. Whether you look at the nominal GDP growth at roughly 10%, the net tax revenues growing at roughly 11%. And it is pretty much what they've controlled the deficit is by limiting the expenditure. The growth, year-on-year growth in expenditure is budgeted at 7.4%. So overall, it is quite a well-balanced budget. And they've also laid down their aim to have a total debt to GDP target of 50% plus minus 1% by 2031, which bodes well for the macroeconomic stability and in due course should lead to better external ratings of India as well.
What is the liquidity situation looking like right now in the market?
See, system liquidity has been in deficit for some time and it has been increasing largely on account of the advanced tax collections in December, and also the capital outflows, and also the forex operations which RBI undertook to protect the currency. And naturally, as you move into a deficit, it's well known that it's a matter of concern. So the RBI, interestingly, ahead of the MPC, as we discussed, came back and announced some measures amounting to roughly INR 1.5 trillion, which is give or take USD $18 billion. And they use multiple channels. They use open market purchases. They use a 56-day variable rate repo. They also announced FX buy-sell swaps that they would undertake. So I think, and they previously already reduced CRR in the previous cycle to boost liquidity. So with this, the liquidity has been coming off. Having said that, in March, we do expect the liquidity deficit to increase, the core liquidity deficit to increase, and we expect that the RBI will use more tools, the same tools or newer tools, to continue to infuse liquidity in the system. Now, we must stress on the fact that RBI, in its meeting today, in the post the governor spoke, he mentioned twice, so he used the word proactively take active measures. So clearly there is intent that they will act as and when needed. The market is a little unhappy that they did not allude to the word surplus, but I believe that as we head into March, when the liquidity deficit will increase, RBI will announce more open market bond purchases, use other tools if required, and keep liquidity at bay at manageable levels. So not a major concern as of now.
Now, of course, while in India we have the fiscal prudence maintained, there's a rate cut as well, there are certain external threats, like, for example, the US president policies. So considering all of this, what's your outlook on India's yields and currency?
So, of course, Trump and his policies on tariffs and otherwise is the wild card, right? It keeps us guessing every single day. We have previously mentioned that we expect Trump to use tariffs as a negotiation tool. We've said it before, and we believe that we don't expect large tariffs to be there on a consistent basis. They could be either announced, they could be a threat, or once Trump gets what he wants from the other country, they could be reversed. That's exactly what we have seen so far. He announced tariffs of 25% on Mexico and Canada, and just after the weekend, he reversed it. Not exactly reversed, but suspended it by 30 days after having got some commitments from the respective countries on the border security related to immigration and fentanyl. One must say, of course, that Mexico also got something out of US. They got a promise to control the bigger and the higher end of the guns that flow into Mexico. Putting that aside, we have seen a 25% levy, which has been put on pause. China, of course, has seen a 10% tariff, but it is so far nowhere close to the big 60% that has been threatened. So overall, the uncertainty will remain. We still believe that this is something to look out for and be watchful of. But our base case is that around these levels that we have seen will be the permanent, the 10% odd will be the permanent amount of tariffs, which is manageable, which is not that big a deal. And we've seen the markets already reacting towards it. A little softer data on employment and inflation in the US, and we have seen the 10-year, which had gone up to 4.75 to 4.8%, is already south of 4.5%. That volatility will continue. To some extent, it will also impact emerging markets. And the volatility in the rupee is something which the RBI has burnt some amount of FX in the recent past. Today, the governor did say ideally RBI should not intervene into the day-to-day volatility and look at the longer-term trends or the longer-term volatility and allow the market forces to actually determine the exchange rate. So basis that, one believes that RBI will not go ahead and streamline the day-to-day movement of INR as much. So the external sector, the reserves of the RBI would not feel that much challenged and stressed, but that doesn't rule out any need by RBI to do so. So it will be a little bit of concern. And I think that is what the RBI is looking at closely. And yes, on the outside, it's a risk, but I think it should be manageable. And most of the negatives have largely been priced in. And as India moves towards a rate easing cycle, a shallow one, 50 basis points, maybe 75 basis points, we expect the rates in India to come off slightly. And then the rupee probably should start settling in at current levels of 87.5, 88.
Tanveer, this was a very insightful conversation indeed. Thank you so much for joining us today. And thank you, viewers, for tuning in. That was, of course, the India Debt Outlook. Stay tuned for more such interesting videos on Kotak International.